over the course of a couple of days, $300 billion worth of market cap was wiped out from particularly SaaS companies.
Today, me and two fellow CEOs discuss what's causing the SaaS apocalypse to add some nuance to the conversation.
The argument you're hearing is AI will replace SaaS. That's a lazy argument. That's not what we're saying. What AI is doing is...
And since the classic VC-funded SaaS model is under pressure, we talk about other paths for high performers who want to grow a career or a business. There's a different way to build a company that is a craft business that is intended to be around for 20 years or 30 years or 40 years, that is completely focused on customer experience, plus our predictions on which SaaS stocks will be bouncing back from the dip.
Was the other one, I think, was oversold.
and I would say will rebound.
I mean, I do think we'll trade higher.
Oh my. That's a wild one. I would not have bet that you went there.
The world is changing, SaaS is changing, and we're giving you the nuanced perspective on how this affects go-to-market operators. Welcome to Topline. Hello, everybody. Welcome to Topline. It's one of your co-hosts, Sam Jacobs. I'm the CEO of Pavilion. I'm joined by my wonderful co-hosts, Asad Zaman, the CEO of Sales Talent Agency, STA, and AJ Bruno, back from the QuotaPath kickoff, the CEO of QuotaPath. Those are my two friends and co-hosts, compadres and compañeros.
Keep going, Sam. Just keep going.
Forever. AJ, welcome back to Topline. How are you?
Good. I was in sunny San Diego. It was 82 degrees. We built sandcastles as a team. We went whale watching.
What were you wearing when you were doing that?
When I was whale watching or building sandcastles?
No, building sandcastles.
I was in shorts and a t-shirt. However, Travis, who's our head of demand gen, I have never seen him without a suit. And he was building sandcastles in a suit. Yeah.
He's scared of the sand or something? Or he
sleeps in it. I'm very confident he sleeps in it.
Wow. Okay, Travis, we're worried about you, brother. But we love you.
I will say this. Either of you ever played Werewolf or Mafia?
Mafia.
So we had a company like 3 nights in a row company game of Werewolf. It was called Blood on the Clock Tower. So everyone has roles. And Pablo Dominguez came. He joined our kickoff. Ooh. He played, and guess what? He ended up being the demon. So shocker. So he lied his ass off.
What is the game? Time. Explain it to people like me that don't know what you're talking about.
There's an evil side and there's a good side. Townspeople, and then there's the werewolves and werewolf. But in this game, there's demons. At the beginning, you get a role, a card that says what your role is and what your special abilities are. No one else can know those, but it says if you're good or evil. Every night you go to sleep and there's a narrator, Travis in this case, and he wakes certain individuals up with special abilities. And at the morning, someone dies. The demon picks a player. But if there's special abilities and there's changes, and so it's just basically a lie your ass off game. And so during the day, you can talk to each other to try to figure out clues.
But no one in the business wants to come across as too good a liar in these games. It's like, that person was an A+ liar.
My performance reviews on my team are based on this game. So we'll see how we do.
Wow.
But I heard you guys had an AJ on the last episode, so I'm excited to listen this coming week when it comes out.
He's a very smart guy. Yeah, he just closed a $100 million deal. AJ,
deal like someone's giving him $100 million transaction.
Yeah. Yes.
Yeah.
Gosh, you guys need to hire him to be your third co-host.
I was like, that's a big. I haven't closed one of those before. Not an investment round, just selling something for $100 million. That's neat. It's got to be transformational. That's what the word is in big enterprises, transformational. Does it drive transformation?
Everyone's driving transformation.
If you're not driving transformation, what are you driving? Nothing. Yeah, you piece of poop. Hate transformation. We're transforming over here.
You have Transform 2021. That was GTM, right? That was the virtual one.
Something. Yeah. All conferences are named the same. Elevate, transform, accelerate.
Hey,
uplift,
ours was making
whatever.
waves, okay? Ours was unique.
Was that TrendKite or QuotaPath?
QuotaPath. That was the one in San Diego, making waves. We're in the ocean.
Oh,
QuotaPath crew.
Good.
We're all crew. Like I did this Frank Slutman conversation on drivers versus passengers, and I was like, look, we're crew. Here's how we set the course. Here's where you need to all step up.
The AlphaSense SKO in Vegas the theme was Be the Storm.
Be the Storm. Ooh.
Be the storm. There's some ancient proverb about this person is tossed and turned by the storm, but the real warrior is the storm. I am the storm.
Yeah, that would be playing Werewolf or Mafia or Blood on the Clock Tower with AlphaSense. No, thank you.
I am the storm. I'm going to Google it. All right, Asad, we're talking about the SaaS apocalypse, right?
We gotta
Apocalypto.
Meltdown. So, AJ, while you were building sandcastles, the SaaS world was melting down.
I mean, maybe that's why I was building sandcastles. I'm pivoting my company into a
Why
sandcastle business.
markets collapse because you took your eye off the ball as usual.
So, the chain of events is this. Anthropic released a couple of new modules, a legal one, a financial one. And then at the same time, in the background, there's this open source product that is caught fire called CloudBot, now called OpenBot. And so the combination of this really scared the public market investors. And what happened is, over the course of a couple of days, $300 billion worth of market cap was wiped out from particularly SaaS companies. And that 300 billion is one thing, but I was doing research for this and I looked at the 10 most notable SaaS companies that are traded publicly in the US. And in the last 6 months, they've lost upwards of 600 billion in market cap. You're talking about companies like ServiceNow that are trading at 100 and less than 150 billion. Some companies like Workday, you'd be surprised what their market caps are right now. They're trading at all-time lows from a revenue to a revenue multiple perspective, earnings multiple perspective. And so basically, the public investors feel, and they're voting with their dollars, that SaaS companies seem to have had enough time to integrate AI into their products and find some sort of growth and acceleration. They have not. And in the meantime, these AI models and the products that these AI companies are putting out are getting more and more powerful. And so they feel that at this point, it feels very likely that these companies are going to get highly disrupted. And so they have repriced them. And so that's just the high level frame. Sam, let's start with you. What's your analysis of this? How did you feel when you saw this? What are you thinking about these days? What's your take?
A friend came over on Friday night for dinner, and he had exported everything in HubSpot, because they use HubSpot as their CRM, into a CSV, their pipeline, basically, like all the deals, the values of the deals. He then pasted that CSV into Claude, and he just began asking it questions. And it was functioning like a high-end BI tool that Salesforce or HubSpot would have charged you an arm and a leg as an upgrade module. What deal should I focus on? Where's there risk in the pipeline? And for the first time, I thought, wow, maybe you don't need HubSpot. Maybe you don't need Salesforce. If all you need to do is get your data out of those systems, they certainly should be repriced. That's one thing I thought. The second thing I thought was, I think the straw man argument, the red herring argument is Salesforce is going away. That's not what anybody's saying. What everybody's saying is the stability and predictability of those cash flows are not as stable or predictable as they were yesterday. And that one way or the other, Salesforce and enterprise database companies, basically static database companies like a Workday or any other system of record, they're going to face tremendous pressure because accessing the data won't be the critical thing. Therefore, they will have less pricing power and less leverage. It's not that Salesforce is going to go out of business. It's that they won't have the same command in the market. You know, the famous thing about Salesforce is like they price in 7% price increases every year, and they just build in, massive net revenue retention. And the fundamental premise there is you're not really going to switch. It's too much of a pain in the ass and it's too difficult. And again, the red herring argument is, oh, well, large enterprises aren't going to vibe code their CRM. Nobody's saying that. Or maybe not everybody is saying. That's not the thrust of the argument. The thrust of the argument is these companies have less leverage than they had the day before. And I agree that they should have less leverage. That doesn't mean software as a category is shrinking. Software as a category will continue to grow. It's just that the database layer, the system of record layer, as the marginal store of value, will decrease relative to the agentic layer, where you're interacting with agents to drive workflows. You don't need the same interaction with the same database that you need. And there will be a market where you add in agentic AI plus traditional SaaS that is significantly bigger than the current SaaS market today, because these agents will touch every part of the workforce, but it won't just be SaaS. And what that means is, I think there's going to be lots of opportunity for go-to-market operators, because all of these companies are still going to need money. They're still going to need revenue growth. And there's going to be a lot of competition for the Matt Braley's and the Kyle Nortons of the world, as Acid and I have written recently. And then the final piece would be for all the companies that are in the middle, where you feel like I'm a SaaS company, I'm growing 30, 40, 50%. And, what's the path out for me? And I would say there is a path, and that path is to become cash flow positive, and not just to stay alive, but to see if you can build some kind of, whether or not you're valued at 10 to 15 times ARR, can you build a cash flow stream that can be dividended back to the shareholders in some way that it just becomes more like a regular business? That's the trick of being like a highly VC financed SaaS business today. You're out of choices if you're not growing at AI rates. And I would say that the choice must be, well, let's build a good business then.
What I'm hearing you say, Sam, which is first off, we've been ahead of this curve for a long time. So thanks for All In and the others finally hopping too. Appreciate that. What I think is the argument you're hearing is AI will replace SaaS, but that's the lazy argument. That's not what we're saying. What AI is doing is it's compressing the time value of money. We're seeing the market corrections happen at a much quicker pace. Here's the thing. It's the question that I'm seeing is how quickly can you replace labor costs? That's what's being rewarded right now. And that's ultimately where I'm seeing a lot of this reaction to this, where there's a Adobe or HubSpot or others, they are not signaling, any of these companies are not signaling yet that they're internally much more efficient as a machine. And I think that that's where a part of this isn't necessarily just the AI response and what's your AI native tool, which I do agree with you, Sam. Like that's part
I
of
actually really agree with this point, by the way, AJ. Guess how many employees DocuSign has?
5,000.
7,000 employees.
Yeah.
You can imagine that being like a 50% team inside Anthropic. You can imagine if Musk bought that company, he'd probably slash like, 6/7 of that company and leave it, and it'll probably still function. And so there is this, I think, annoyance that the public markets have around the structure, the employee count, the bloat within these organizations. That's one. But I think, AJ, and I'm curious to get your thoughts, I would imagine that the public markets would have given them time to figure the internal out, as if they were able to show that their products were eating labor budget for their clients, one, and two, was showing some real acceleration. It wasn't just words on it in a kickoff, but it was showing up in revenue acceleration. And I think what they're frustrated by, and it's a really interesting problem, which is that none of these at-scale SaaS companies that over the last 2 years have released AI products, have agents, have AI products, none of them have real acceleration, like of any real sort.
They're barely even add-ons at this point too. Like if you acquired a company traditionally, you could look at the TAM and say, okay, we can look at the attach rate of this at like $200 million over the next 2 years or whatever. The market's no longer rewarding software adoption. It's rewarding the economic displacement, or just quite simply laying off people. So like, I think that that's where this time value compression is really taking place, because if you're a company and you're at 7,000 people, that's a big ship to move. To pivot faster, you have to shrink heavily down. And the market is looking at this and saying they're not doing the thing that they need to do, and they're going to be dead.
I don't think they're being penalized for not cutting headcount, to be clear. They're penalized because they're not growing.
I don't know. Like HubSpot has beat the market expectations by an average of 3.5% the last 8 quarters, Sam. I don't agree. Their stock's down 72% year over year.
It has nothing to do with the number of people that work at HubSpot and how efficient they are. It's because people don't view their ability to grow into the future as unending as it was a couple of months ago. Like, this is all about growth. This is about the fact that these companies are struggling to grow. If you're leveraging AI, if you're part of the new movement, your revenue growth should be accelerating. It's just that simple.
I think headcount has the following to do with it, AJ, which is that most important is revenue growth. Everything else can be forgiven. Your burn can be forgiven. Your margins can be forgiven. Everything can be forgiven if your growth is really good. If you're one of the few companies that can say, look, we're accelerating. Like, look at Palantir, right? Like, it's basically the screaming example of what the public markets want. The Palantir at scale re-accelerated. and it trades at what, 100 times something, like it's trading at this astronomical number, because the next company after Palantir that was the fastest growing company in the public markets was growing at 30%. Palantir was growing 60%.
Yeah, but Palantir's
And
down
so
25% in the last 6 months.
that's just because it was trading at such an insane valuation that it had to come down, but it's still trading at the most premium number you can find in the public markets. Even in terms of private market valuation, it has got a really high valuation. So you can see that growth is being rewarded. I think Databricks is another example. They just raised $7 billion.
And Databricks is accelerating their growth. I think the reason the headcount is an interesting point, AJ, is only because it should correlate to speed of decision making and
Exactly
speed of
right.
product
That's
release.
where
Not
it's the
because
first
there's so
in.
many.
Yes.
I don't think anybody cares whether DocuSign has 10,000 or 5,000. I mean, maybe they care. If they're worrying about operational efficiency to drive cash flow generation, they don't believe it's a growth stock at all anymore.
Yeah.
Once if a public markets
Then
are
it's
like,
trading at 1x.
well, you could do what you're doing for half the people. It's like, well, but then you're not a growth stock, because a growth stock should be accelerating right now.
Yeah. If you have the growth, that's most important. Everything else can be forgiven. But if, let's say, growth is okay and they see that you're acting with decisiveness, where you're saying, listen, guys, we recognize the moment in time that we're in. And for us to be able to build the right things and find that growth, we need to change the design of this organization and the structure and the size of this organization. And I think that would buy you a little bit of time. But eventually, it all comes down to growth, and they just don't believe these companies are going to figure it out, because none of them have figured it out yet.
So if you're an operator at a company that's doing 10 to 30 million to 100 million even of revenue, and your growth rate is 25%, which 2-3 years ago, well, maybe not then, but like that 25 to 50% year over year, cash flow positive. You're sitting there as an operator and you're listening to us talk about this. What are you supposed to do?
How cash flow positive?
I mean, probably close to break even, not in like the margins where it's just a PE, like
you're worth
cash
$0.
cow.
Yeah,
You're worth $0.
You're worth nothing.
So what if the internal team is like working through and they've like, okay, we figured out our AI native, we've got this strategy, we're going to go launch it. You're dead in the water already.
The whole point is, if all of those things are true, we'll see it.
Yeah.
We'll see it in the growth rate, or we'll see it in profitability. If you're growing 25% a year, that doesn't mean you're not worth anything, but you have to be more than break even. You have to be. You have to be generating. If you're a $50 million business, growing 25%, I need you to be generating $10 million of EBITDA. And if you're generating $10 million of EBITDA, and I have confidence that $10 million will stick around because you're growing 25%, even if I discount the growth, okay.
Yeah.
I can get you to, I can get you to be worth $150 to $200 million because you're generating the cash, because it becomes a math exercise of, let me add up all these cash flows. But if you're generating $50 million, growing 25%, and you're just breaking even, I need you to either grow faster or be more profitable.
Well, either one of you, would you have had that opinion 2 years ago?
No, I wouldn't have. I would have said
So
you're
we're in a
worth
bubble.
probably.
So this is going to change in 2 years.
What? What is that? No, I think that's the misuse of the word bubble.
Yeah.
Market conditions have changed. I don't know if it's a bubble.
You hear the term markets are efficient. And this is kind of the efficiency of the market. It's not perfect. The market is basically saying that we need to reprice. They're going to reprice somewhat inefficiently. The efficiency of the market still it shows up a little inefficiently, meaning that everyone will get cut, and they'll get cut a little bit too much. Like, they'll cut some bone right now. That's the way the market works. And so when you see some of these organizations that are systems of record, that are very sticky, will some of them come back up a little bit? Yes, a little bit. That's how the market works. But this wasn't the case a couple of years ago. Like, the game on the field was different than AJ. And so the game on the field has changed. And now, if you are an entrepreneur, you're an operator, you have to recognize what the game is, which is kind of what Sam said. You have two options. You can play two games, I think. You can say, I don't think we can find the sort of growth that will enable us to fight for a revenue multiple. I don't think we can do it. And it's not just I don't think we have the capability part. There's a really interesting point Lemkin made, which I hadn't realized, and then it's just been in my head a lot, which is that the leading indicator of AI-driven growth is inference cost. Inference cost is a lot. If you look at these AI companies and how much they're spending on it, it is astronomical. So even if you are a company that builds the product and your customers like it, you might not be able to afford to be able to service the cost of being able to provide it to them. Like if you're Gong and you do reaccelerate, you can't go out and raise money right now. So how are you going to pay for this stuff? The AI native company that you're fighting against is at an advantage against you there. So they might look at that side and be like, too complicated, I can't do it. If you can't do that for whatever reason, then you have to become a profitable organization, and then you can trade an EBITDA multiple. And then you should trade sooner rather than later because the game keeps changing and the acquirers are strategics or PEs. And PE is a much larger acquirer than strategics. And they're also slowly getting more and more concerned that they'll be able to turn these businesses into something valuable in a few years and flip them.
One data point from last week, have a close friend that we both know. I was talking about the company that he was looking at and thinking about joining. And he said, AJ, the executive team is forecasting they're going to go from 7 million to 125 million in revenue this year. And he's like, the crazy thing is they have 26 GMs. And when you do a roll up of the GM's forecast, it's $260 million. When have you ever heard of a roll up forecast of the like basically the VPs rolling up a number?
They're at 7.
They were at 7 million to start the year. The GMs are forecasting $256 million in revenue this year.
This is an AI native new startup.
AI native company that's in like conversational intelligence that's like basically global. These are huge enterprise contracts that they're rolling out. My question to you all is, we're sitting here talking about the unicorns that if they're similar to 2 years ago, the percentage of those companies that exist out there is quite low, right? Like what is the percentage of our listeners? How many are listening right now that are sitting in a seat at one of these companies?
Very low.
Let's say it's in like the less than 10%, because that's probably being nice. So we're sitting here talking about the market and talking about these companies that are not on that side, not the 90% companies. And you're an operator in those companies and you're sitting here listening to this. What do you do?
Depends how you look at it, by the way, because if you think about this market cap that was wiped out and we're calling it SaaS, apocalypse, and all of those things, we just wiped out one Anthropic. Like the numbers have gotten a little bit like it's hard to, a billion used to sound and feel big. Now you have these numbers that are just like, it's hard to, I'm like, okay, we wiped out 300 billion. That's just an Anthropic. It's actually smaller than an Anthropic. It's actually kind of interesting how mentally it's hard to like contextualize how big these things are, and value has just got this. I've got a strange relationship with numbers right now. I'm trying to like compute them. And so I don't know if you're talking about it from a market cap perspective. I would imagine it's a much larger percent than what you're given in. I would say, at least from our listeners, there's a much larger percent that are working for AI companies than you're given. Maybe it's like a 40, 60, 50, 50. If you are at one of these, let's say, old world companies, you have to really ask yourself, and you have to have these, I think, very transparent conversations with your team that like, what's our game plan here? Like, what are we doing? What type of business do we want to be? And you're going to get one of those two answers. We're going to go and try to find growth. We know that's the riskier one, but we're going to go for it. Here's our game plan. Or we're going to try to become EBITDA positive, generate a lot of cash flow, and we will trade at that. And you have to decide if you really believe that a probability of either of those things happening is high or not, because if you don't, you need to get out. Listen, there's a small window of opportunity during a platform shift where there are really no AI workers, right? Like how many AI salespeople are there? The market's growing too quickly for the people that are already in AI to be enough. And so there's a window of opportunity for people from the old world to enter the new world. When I started in recruitment, which was about 12, 13 years ago, SaaS had been around for a bit of time. But there was still this openness with like mid-tier SaaS companies to pull people in from outside of SaaS. So they would say, hey, if you find me somebody that's been selling on-prem, I'm open to it. Sometimes they were even open to people selling hardware, and we'll help them transition to SaaS. Right before AI became a thing, if you took a low tier SaaS company and you presented a hardware salesperson to them, they would be like, are you insane? Like, what is this? How can I hire somebody who has not sold SaaS before? Like, it had completely shifted. The window had shut. Right now, the window is open. If you're from the old world, you can enter the new world. That window will get smaller and smaller as time goes by. So if you are not confident in your company, this is the time to make a shift and enter the new world.
There are people that have worked at this company that I was giving a talk to for 25 years. And I said exactly what Asit said. I said, because it was a talk about how you can become the future go-to-market operator, and one of them is AI nativity. And I said, just so you know, because there's a lot of people out there and they're listening. Some of them are listening right now. And I want to tell those people that I do judge you. When you say, you know what, I've been in AI for actually 50, I've been in AI for, what are you talking about? What are you talking about? You don't know what you're talking about. Nobody
Machine
bought your
learning,
thing.
natural language
Nobody
processing,
does.
Sam,
Nobody
NLP,
cares.
baby.
You're not part of it. You're not part of it because you
Semantic
say
search.
that. And my point is, like, 2022, November 2022,
The world
that was the
changed.
man on the moon moment.
Yeah.
And everybody's new. And you can be one of those people. It doesn't matter. You can be 55, you can be 65, you can be 12, you can be 18, you can be one of those people. Your age doesn't matter. You can be one of those people. Your upper limit is determined by how quickly you learn, and you can be one of those people. Lemkin's been doing great work. You know, I think his insights are really, really strong, but he's talking out of both sides of his mouth because he reposted again today. He's like, two people that had $200 million businesses that walked away from their companies. You know, I can't believe they quit. They took people's money. Like, are you up for the challenge? At the same time, he's like, if you're not growing 500%, go kill yourself. Here's a gun, you know, like shoot yourself in the face because you're a loser.
That's the type. So I fully agree with everything you guys are saying. What I don't love right now is just the hyperbole type of talk around companies that have good growth metrics, sustainable, have renewal cycles. They're like have an AI native response to it, and the team culture, all of the traditional things that make a SaaS company great exist. And like, nope, you're dead in the water. That's what I dislike right now.
But listen, I'm not.
But I don't think that's what they're saying.
I'm not trying to.
No one's saying
Yeah,
the
I'm
dead.
saying you have to build a different kind of business. You know, I've had this idea percolating, and I just don't like the name of it. But I keep thinking about like what are the hallmarks of this era, and how can you do everything the opposite of them? And so the hallmarks of this era are transactionalism, hypergrowth, you know, inefficiency, slop, you know, lack of curation, lack of taste, lack of aesthetics.
Like, yeah.
Like being, you know, it's like, what's the opposite of Adam Robinson? It's like Substack in a way, right? Like one thoughtful thing a week as opposed to just like in your face game show host twice a day.
Yeah.
Right. So the name for it I have is like the slow growth movement, like the slow food movement, but nobody wants to sign up for the slow growth movement, but it's something like that. But my point is like, you can choose to build a different kind of business. We don't have to build the business that all these people tell us to build. Asit's not building that business. You know, Asit's commenting on these businesses, but he's not sitting here growing 300%. He's like, we're going to do $2 million in revenue this month and $1 million in EBITDA, and I'm going to take half of it, and it's going to be great. You know?
Firstly, no one's saying you're a loser. What they're saying is you have to pick what you want to do with your business now, especially if you care about enterprise value, right? Like, I don't know my enterprise value. I actually have no idea what ST's enterprise value is. I don't care. I'm never going to sell it. Like, I don't have that choice to make. But if a person is thinking about selling, then they have to think about, well, what does the market want? Like, what does the exit market look like? And the exit market is going to have two options for them. They're going to let them trade on growth, and you can trade on a revenue multiple then. Or you trade on EBITDA because you're growing slower, but you're really, really cash flow positive. You can choose to play some other game. Just don't expect somebody to want to give you a lot of money to buy your business from you. You can play, the game I play is like, hey, we actually a very profitable business, so we could trade on EBITDA and trade really well over there. We just have no interest. We're happy growing at a nice rate, making a lot of money. And I like doing other sorts of things as well. Like I like the media stuff we do. And I think these things play well together. And I'm playing my game. I'm very happy. But a lot of people are playing to have an outcome. They're not doing their life's work, right? Like most people that you meet in our ecosystem are playing to quickly get to the end because they believe that as soon as you have an exit, all your dreams get answered and all that insecurity goes away,
Nope.
all that chatter in your brain,
Nope. AJ,
and you don't feel
AJ's got
miserable
everything he wants
anymore.
in life.
I have
He has no
everything.
insecurity.
Everything. I'm great. Everything is
Yeah.
fantastic. It's
I-
peachy.
No, it's after the SpaceX IPO. Then everything
Oh,
will
then
be
everything
great.
will be fine. Actually, then yes.
I don't know. Like, I think the more you will feel miserable till you work on not feeling miserable is kind of this recent lesson I've learned. Like, it doesn't matter what your bank account looks like or any of these other things. If you don't want to,
That's the thing that I think I heard the terms thinking about multiple and enterprise. You said enterprise value, but thinking about your multiples and what you have when we were talking about it. But at the end of the day, if you're not selling your company, then you're focusing on customer value on whatever the thing is you're doing it. And that's the point.
And if you're an operator and you're making 300, 500, 500, 600, whatever you're making, and that's not enough for you and you want more, okay, then you have to consider these things. You have to consider what's AJ going to do with the company and when's he going to sell it and what's the value going to be. But I think it's incumbent upon, again, to the point of, and I'm taking suggestions. So, I know we've got listeners, Jackie, Charlie Moss, Mary Kukkonen in Sydney.
Slow growth movement.
Yeah, if you've got a better name than slow growth movement, because nobody,
If you call it slow growth movement, you could call it the loser group. Like, it's not something else.
Listen, we're all sitting at the same lunch table. It's okay. We're a good family at the loser table.
My point is, there's a different way to build a company that is a craft business that is intended to be around for 20 years or 30 years or 40 years, that is completely focused on customer experience. And yes, has the constraint of we have to be profitable. Like, we have to design this machine in a way that it spits off lots of cash. And that's our puzzle. Our puzzle to figure out is, how do we design this thing so that it generates a predictable amount of cash, delivering exceptional value at a taste level that meets the highest standards? That's the business I'm trying to build right now.
There's so much value in like trying to see what everyone's doing and thinking like,
what's exactly the opposite,
right? Like, if you think about content right now, there's no shortage of short form content, of low quality, high volume, sloppy stuff. But what we've also seen, like you've seen this on Substack recently, we've seen this with the top line editorials, that there's also a lot of demand for really high quality content at the same time, right? And so the only way to win isn't to play the short form, high volume, low quality game. You can play the other side of it. So much of the actions we take are because we're trying to feel a certain way. We're trying to like get to a certain point for ourselves. And for some reason, our ecosystem believes that the exit is like this
reward.
Like, they really do. And we published this Q&A with Matt Braley, who's, in terms of CROs, had a really credible exit, right? Like, there's some founders who haven't made as much money as he did through his exit. And I thought he said something really interesting, which is like, he's like, I had it, we celebrated for a week, and then I was like, okay, now I still feel the way I feel. And he had to spend the next 2 years doing some real work and getting past his demons and finding himself and finding the joy in life, and sometimes we feel miserable and we think that there's a chip on our shoulder from like our pain and our complexities and all of those things. And maybe at some point that can be fuel, but it's bad fuel. And over time, I think it was the Figma guy. He's like, don't fall in love with the chip on your shoulder. You can get over it and you can still be good. And so it's like, if you can separate yourself from thinking that the exit is the answer, you might start thinking about, do I like what I'm doing if I was doing it forever? And what could I be doing that is at the intersection of my skills and my interests that's also economically viable in this market that I could be excited doing forever? And kind of go towards that. And you might find the thing that you're actually looking for.
It's like a brand investment versus demand gen investment. The challenge, playing a long game versus a short game. Well, the challenge is fear. The challenge is fear. I've been thinking, what's the opposite of LinkedIn? So I've been thinking about personal brand, right? Personal brand isn't just what you say. It's when you say it, and it's where you say it. And of course, it's how you say it, right? So Adam Robinson being every day on LinkedIn, what's the opposite of that? Maybe it's not being on LinkedIn at all, or maybe it's being inconsistently on LinkedIn, right? That's part of the brand, right? So you're like, I'm not going to play the LinkedIn game. I don't want to play the algorithm. What's implicit in that? Because there's a lot of people that say, you're just being stupid, right? LinkedIn has 1 billion users. So why are you choosing to play where all the people are not? And you might answer, well, because I'm building a brand of being a little bit elusive, a little bit less available. And now, again, the counter argument to that would be, you're just playing to lose. Like, that's stupid. You should play to win. But the point is, what would you have to believe if you said, I'm playing to be a little bit less available? You'd have to believe that you'll be doing it so long that ultimately the people that you want to find you will find you. And you'd have to have the confidence that that would happen. And the confidence would only come from the faith, right? That you knew that if I'm doing something I love, that I'm good at, and I'm really applying attention to it and care to it, over time, people will find me. And I won't need to be a hacker. I won't need to write a book about hacking LinkedIn. It won't be about hacking LinkedIn. It'll just be about sharing my ideas in a way that feels natural and creative to me consistently, with the idea that, yeah, my goals might not happen in next year, but I'm trying to be alive for another 70 years. And so they'll happen at some point in the next 10 years. The hardest part of all of this is, well, first of all, if the company raised money, they're on a timeline that isn't just about whatever the founder wants or the employees want. And the second part is, there's this fear what if you're a sucker? What if, like, I'm just going to do this forever at a super high quality, and the good people will find me. And the fear is, what if they don't? What if they don't? And what's the answer to that? And the answer is faith. You don't have to believe in God, but you have to believe that good work wins in the end, as long as you're willing to do it for long enough.
Yeah. So slow growth movement, huh?
Or, as Asad said, the losers club.
I think, I probably post the least on LinkedIn, but I'm fairly well known in our space, and I drove close to $10 million in revenue last year. And I think what you're saying is totally possible, because I've seen it work, but you need patience and it takes time. And when it's not working, that's the market telling you that you haven't found the right quality level or the right channel, because you need some channel, right? Like, we're not saying, like, lock yourself in a closet and don't speak to the world. We're saying, like, try to think of, like, different ways that are authentic to you, and that can work too. Like, it really depends on what you're trying to do. But if you're trying to play a very long game, then you actually have patience. And especially if you are cash flow positive and you're playing the long game, you have a lot of time to play. You just have to find the thing to say and the place to say it, and give it a little bit of time. And you will learn. There's a great feedback loop in the market. AJ, when you think about the founders right now that are at 10, 15 million, 20 million in revenue, they don't have the sort of growth that AI companies have today. Maybe they're growing at like 50%, 40%. And they're burning a little bit of capital, but they want to they feel like, hey, we're small and nimble enough where we should be able to figure this AI thing out. We have a little bit of money in the bank. Let's invest and try. The one challenge they have is that if they were to find the right product, then the inference cost is going to kill them, and they don't have enough money in the bank to pay for inference for a year to be able to show enough growth to then go and raise new money. What do they do?
Well, I do know a few of these type of founders. I think first and foremost, what's their mindset? A lot of these founders are tired. They've gone through so much over the last 10 to 15 years, and they've been in this period where they've had grit and grit and grit. And so think about it just from an age standpoint. They're probably, take me, for example. I'm in my 40s now. I have kids. I'm not in my 20s. I'm not doing the 996 that was required when I started this company, which I did. And I have family and activities, and I'm doing all of these things, and I'm working to balance that. A lot of these founders are in that same boat where they've built a company, it's working, but they're maybe not ready to fully just like jump in and just have to repivot the company, have to cut costs, have to do this all again, because those are really, really hard emotional decisions. And therefore, they've missed their window. They tried to sell it last year or even like in the last couple of years and don't have their window. And so my advice to them is to take a step back and actually, I think what you said about Matt Braley is really interesting in terms of going through an exit And then he traveled the world. He and Avery, his wife, traveled the world and like figured that out in some way. They really have to have a really good coach, someone that they're listening to that can objectively just tell them, hey, I'm looking at your business. It's not AI native. You're not growing at the rate you're growing. You're dead in the water.
And do you think that the coaching game is also evolving now, where the value exchange of working with a person who, ended that first career like 10 years ago, 15 years ago, and is now, doing the second thing. And since then, 2 platform shifts have happened. Like, how valuable is that interaction?
That's a consultant, though. Those are the consultants that have been around. We've all seen those that are just kind of in the. I'm a coach. What they're really good about is asking the right questions, because objectively, I as a founder, you as a founder, CEO, Sam, you as a founder, CEO, you guys know the answers to things. Unlocking the right question will lead you to the right answer, because we know we're founders. We know what the answer is. We just need the right question sometimes to unlock that. And a good coach, regardless, that's like transcends time, that's timeless, can be able to ask those questions. So I think having someone, forget about it being a coach, but having someone ask you the right questions to really get to that answer, you have to pick a lane. We just talked about this whole episode of like, what do you ultimately want to do? What type of outcome? Is it really that customer value? This is your life's work. This is what you're going all in? Or is it that other lane where, hey, this is the market. This is the boat. You want to get all in on the growth, then you got to get all in on what that company needs to look like and what you need to do and reinvent yourself. Those are the 2 lanes. That's it. Pick one.
I think if you can show the leading indicator of growth to some investors will give you some money. If you can find that, hey, listen, look at this. The usage is there. The inference costs are high. We've got 4 months, 6 months worth of inference costs in the bank, but we need more money now. But look, it's working. Like, somebody will give you, maybe it won't be Sequoia, but somebody will give you money. Maybe you won't raise the biggest round from the tier 1 funds, but somebody will give you money.
There's a tier 1 fund that invested in a company. I talked to the CRO yesterday, and he's like, AJ, I joined this company 6 months ago. We went from a $1 to $7 million. Okay. And this investor who joined in March of last year is like, every board meeting is a death march, and we have to meet every single month, and they're crushing us. And we put on the table that we were going to go from 7 to 22, and they said, that's not good enough. You need to go to 30 million this year. They came back, pushed hard. And I was like, what is going on? And I was like, tell me about the expectations from last year. What did the CEO say to that board member they're going to hit? He said, oh, they're going to hit 12. Well, you hit 7. So of course that's what's going to happen. It's all about expectations and aligning. And now you're going to be in big trouble, because you're going to do some unnatural things.
From 1 to 12.
And they hit 7.
And the investor is like, you loser.
You're a loser.
Right.
And then they came back with their financial plan and said they were going to go to 22. And they're like, that's not good enough. You need to go to 30.
So they try to go to 3x, and they're like, you at least have to do a 4x.
Correct.
More than a
And
4x.
now he's like, AJ, the business we're doing, like we're over promising on things. We're a healthcare tech
You know
company.
what's going to happen, by the way? This next generation of founders, because you see this with the younger generation, right? They learn the lessons of the past. Like, one of the lessons this generation of new founders has learned is that you got to be good at distribution. So they're much better at distribution than the previous generation. I think at some point they'll just realize there's like 1% of investors who are like amazing in value adds, and STA works with all of them. But 99% of them are just like, are such a drain and a drag on the organizations. Like, they are being driven by their incentive plans more than anything else. And then they end up doing this sort of asinine stuff at the board level that, for an organization that's actually should be feeling great about themselves, they end up feeling like they're losers. And this is almost people that I think have not been operating for a long time, or probably weren't great operators, or just are in a strange mindset where you don't realize that a business does well when its energy is good, when people feel excited and motivated, when there is an enthusiasm and a positivity in it. And if there's an organization that went from 1 to 7, and after every board meeting, you take their energy out, you sucked their energy out. If you were an employee and not an investor, you would have been fired from that organization, because you're sucking people's energy out. But you feel so good about yourself, coming at the board level and doing this sort of asinine stuff, it is mind-blowing to me. And I think what's going to happen eventually is the next generation of founders will be like, let's just treat them transactionally. Let's sell them a dream, take their money, make them sit on the board. They'll tell us what they want to do. They want us to do A, B, and C. And we'll say, we have your money already. Screw you. We're not going to listen to you. What are you going to do? What you going to do?
That's exactly the conversation that the CRO wanted to have. He's like, we have board control. We're able to do these things, but my CEO just listens to everything they're saying. He's first-time founder through this. This is the same cycle we've been in, 21, 22. We went through this exact cycle in terms of the money and that cash was so cheap that it was easy to take.
What's your take, Sam, on this?
I don't think any of this is any different than it's ever been, to be honest. I think, I don't know where they're going to learn any of this stuff from. I don't think there's some canonical knowledge that's being passed down, and I don't think they're more sophisticated. I think they're
because
they're going to learn
dirty little
different
secret
lessons.
is that we as second-time founders we get our kicks from this happening. Like that founders have to earn their stripes and have to go through it. Like that's just the reality of the world.
And I don't think anything's nefarious. I think it's what you said, Asid. Everybody's acting out their incentives from the perspective of the board. They probably don't have that many winners in their portfolio. What should they say? They've got a portfolio of 20 companies, 10 companies. None of them are breaking out. What should they say? Should they say, keep going, we're happy with you? Their belief must be, right? Like the only belief they can have is like, my advice counts for something. So I got to tell this person to run faster. I certainly don't want to go to my, GP meeting and tell people that I told the company that they're doing great when they're not running fast enough to return the fund. And we don't have any other fund returners. And every other company I've led the investment on hasn't performed. Like, it's just exactly what you said. It's just incentives. What do you do? I think the main thing you do is don't feel bad. It's not morality. To the point, AJ's point, right? You control the business. You're not going to do what they want you to do. That's okay. This is capitalism. This is the nature of capital. Capital is finding its home. It's finding its most productive use. They tried you. You weren't the most productive use. That's okay. It's not God, So I mean, the main thing you can do is act transparently and be honest and open and don't cook the books and don't lie. And then you have to decide what you want to do.
As we are doing this, news that Workday is replacing their CEO.
Yeah, I saw new CEO.
The original founder is coming back. He's back. Founder mode. Obviously, whenever this founder mode type of thing happens, it has a lot to do with that person is probably best suited to revamp the product and have a real point of view and a vision on what we need to do to be able to keep winning in the future and then be able to galvanize the resources internally to be able to do that. We saw this with Fletsport a little while ago, a number of such examples. It obviously means that people are recognizing that you have to really take a look at the product vision and change a bunch of things to be relevant in the future. Otherwise, you will become a company that used to have a really high percent of an individual who uses the software's time actually spent in your product. And now you might just become a database and something else on top of it is where they don't want to spend their time. And that changes the value of your organization. So AJ, as you are building, like when you see what's happening right now, how does this affect how you think about quota path? Do you feel like as people are moving more and more towards using Claude and agents, are you going to run towards that direction from a product vision perspective? Are you going to run towards being a middle layer that might not have a lot of direct usage, but plays a really important connective tissue role? Like, what are you doing at the product level?
I can take the keynote that I did last week as like the example, and going into any keynote, and I think about this as a founder, not just as a CEO, my job is to inspire. I get the job to dream and the opportunity to do it, and my team can pull me backwards into reality, but that's okay. So using that as an opportunity, I thought a lot about exactly what your question is, Asid, in terms of how am I going to communicate to the team on what the next 18 months of real work, like legit the hardest we've ever worked in our lives, is going to be, because the world is changing so much and we just have to continue to communicate and align always. So I started with the idea of like, here's where we are in this journey. Use San Diego. I lived in San Diego for 2 years. I would go running on the bay, exactly where we were, the Bahia, And I would think and dream and think about incentives and think about building the company and think about my plane that I wanted to buy and land in San Diego and think all through these things in order to land at a kickoff just like this and be able to communicate. So I took that as an opportunity to say, here's where we are. Here's the why behind what we have to go do. Here's what we're building. Prescriptively, this is how it helps our customers, how it helps the CRO, how it helps RevOps, how it helps the CFO. This is the timeline that we need to go do it. Here's my expectations for how you are going to help. And by the way, all along this talk, I acknowledged the work that they've done. We had Navigator of the Year. We have Value Awards. It was very celebratory. That is an important part of this. And as an operator, as you think about this, if you're asking your team to go do something, you have to make sure that they know that you know they're the right fits. They're on the right bus. Maybe they're not in the right seat, but that you're going to guide them and lead them into this chaos that we are going to currently in safely. So for me, it was all about one word, and that was inspire.
Do you feel like you landed that plane?
I'll send you the keynote and you guys can judge me on it if you're interested.
The slides in the video, we need to see the video.
Yeah,
to tell you.
I am happy to send it along and to you two. And I think it's all about outcomes. And I will know if I landed the plane if the outcomes are there. And if I gave the right incentives for the team to land the plane.
I'm sure, by the way, you were inspiring, AJ. Just to be clear, you're very good at that stuff. So
my
I'm sure
acting
that
days, Puck in Midsummer Night's Dream. If we shadows have offended, think but this and all is mended.
But this and all is mended. That you but slumber here while these visions would appear. And this week in idle theme, no more yielding
but a dream. Gentles, do not reprehend. If you pardon, we shall mend. Sam, how do you know this?
Dead Poet Society. Come on, let's be honest. Robert Sean Leonard, that's Puck. What I was going to say is the Workday CEO being replaced. I just think sometimes Steve Jobs coming back will save the company. Most of the time, market forces are bigger than any of this stuff.
Intercom's founder CEO came back. How's that playing out for them?
Very well, I think, right? Didn't they?
There's Bob Iger went back, and it was probably a very bad move, right? So it's like it's not always going back is not always the best. It's a coin toss. It's a coin toss. But if you are that person and it's your baby and like the world's changing, what are you going to do? Like if you feel the inspiration, go back in, give it a shot. Like what's the worst?
Of course.
Yeah.
You know, innovator's dilemma is a very real thing.
Yeah.
Because the answer to a lot of this stuff is rip up your business model and try, outcome-based pricing that has an agentic layer. It's like, okay, you're displacing thousands and thousands of people's jobs.
It's all marketing talk anyway at this point. Like it's got to be, that's marketing speak too. And that feels, there's a lot of it that's just fluff. What's the real work?
None of us have a 100-person organization. All three of us are under 100 employees. And I don't know about you guys, but obviously there's nimbleness at our size and scale, but it is hard to move it around. Like it is hard to move this organization this way and that way. We re-engineered the business over the last couple of years. It took a couple of years to re-engineer the business. You can't do everything in one go. So I have a lot of empathy and worry for companies with 1,000, 5,000, 7,000 employees trying to adjust to a platform shift. It really does feel like they are at a massive disadvantage because the advantage of resources, what do you have? What's your comparative advantage to the new firm?
That's exactly the point.
It's
like you're gonna rebuild your whole business as an AI native agentic layer. Okay, sure. Why are you gonna win that race?
Yeah.
Like that's a race everybody's playing. So you're just it's like, well, that's what I had to do. I mean, again, that's capitalism. Like the market forces you to make these decisions. It's a rational decision. It doesn't mean you're gonna win.
Guys, this has been a good discussion about the end of the...
Do you think it's been a great discussion, or you just feel like it's been good? You're a little lukewarm on the discussion?
No, I really enjoyed it. It energized me. You know what I like about this? I was having I feel so miserable sometimes. I need to figure this out in my head, but I was having the worst day ever, probably the worst week. And when I'm having a bad week or bad day, I feel very grumpy and short and testy. And I actually feel
I wouldn't know anything about that. You didn't send me an email before this that was short or grumpy.
Sorry for being a little aggressive. And so I feel energized and jolly at the end of this, which says a lot about hanging out with the two of you. So I actually really appreciate this.
That's nice.
How do you feel about the conversation, Sam?
I feel good. I mean, I think sometimes there's no easy answers for people. You know, it's like, what do you do? What do you tell people? And what you tell people is the path to enlightenment is letting go of desire. You know, like, that's what you like. What you,
I don't
you
know,
have, like,
Sam. I can argue that one. I think there's some sort of releases you have when you lean into desire that you feel very enlightened at the end of those. So I don't know if it's letting go of desire.
you have to remove the conditions on your happiness. That's the bottom line. You know, you're saying, I'll be happy if there's an exit. I'll be happy if we make this money. I'll be happy if we hit this target. It's like, okay, well, that's on you. You're inflicting pain on yourself. Why don't you find, and that doesn't mean don't be aggressive or ambitious. Don't try to build something huge. It just means there has to be an element of release. You have to find your place now in this moment as you're listening to this podcast to find joy. It can't be like everything predicated on some exit that is receding from your eyes. So what? You're going to tell yourself, I'm never going to be happy now?
I agree.
I
100%
tell you,
agree.
like I grew up in in Pakistan. I went to some villages that it was so poor. They didn't have like running water, electricity. The way they would keep their houses warm is they would take cow shit and put it on the walls because they would insulate the house. Like in those villages, you would find people that were really happy, like true happy, like happy. Even if you go to Cuba, like, you know, you would go around there and you would find people that when they laugh from their stomach. Like you can find happiness outside of resources as well. Resources help with other sorts of things, but happiness seems to be its own journey. I actually think, Sam, that some of this is also probably at like, we don't, like if you're a man, so after you turn 30, your testosterone drops from 1 to 2% a year. And so when we are at like in our 40s or late 30s, early 40s, 50s, and we feel lethargic and grumpy and we don't sleep well and it's hard to find excitement and joy and enthusiasm, like it's important to go do some blood tests as well, because some of it can be at that level. Like I'm going to do one because I'm like, why am I feeling so off? And I wouldn't be surprised if I come away and it's like, your testosterone's lower than it should be. In which case I will happily take TRT, lose some hair, and then do a hair transplant.
You'll no longer be 26 years old.
I don't want you to lose any hair. Your hair is gorgeous.
I will get a hair transplant. Don't you worry, man.
No, it's not. I don't want you to get a hair. We're sticking natural hair, baby.
Natural. We're going to be low testosterone, natural hair. Okay, want to do a question?
Yeah, let's do a question.
Okay, what is something, if 12 months from now, same time next year, pick 2 public stocks that are SaaS companies that you think will be trading higher than they're trading today? Or just pick one from each of us. Sam, you can take the first, and AJ, you next. I'll go last.
Oh, okay. Public SaaS has to be SaaS or just a public
SaaS.
I mean, I do think HubSpot will trade higher.
Oh my.
So
that's a wild one. I would not have bet that you went there. Okay.
Listen, I was going to say, when you're talking about markets, markets are a voting machine in the short term and a weighing machine in the long term. I think it's been a little excessive. I think if you look, they're growing revenue. I understand. Well, maybe I don't understand. I need to read some analyst reports, but I just feel like it's been a little oversold for the performance of the company.
You don't think HubSpot should trade at 2 times revenue as it is probably right now?
It's not 2, it's 3x.
Whoa.
So there you go. That's mine.
Oh yeah, AJ.
Is it cheap? Because I followed HubSpot like on a weekly basis, and I'm a big stock owner in it, and I'm using only public information for it. Can I pick it?
HubSpot? No.
I'm not allowed to pick HubSpot?
No, you have to pick another.
Okay, well, I'm going to go the other stock that I've been looking at and following, which we actually haven't talked about, is Adobe. And Adobe has had the same downward trajectory as HubSpot. You can look at Figma as they have a lot of competitors. AI hasn't helped them. They early adopted it and it didn't really work with some of their applications. But I do feel like, similar to what Sam said in the weighing machine comment, I feel like Adobe has, over the long term, has shown that it's a very, very successful company. And I would say Adobe will rebound.
It's a very, very sticky piece of software. I really like your pick. I think, similar to you, I think there are these really sticky, ingrained softwares that are hard to change people's behavior from. Adobe would have been one that I think about. I'm actually building a position in Adobe. ServiceNow is the other one. I think ServiceNow is oversold. And I think it'll come back up a little bit. I do not believe any of these companies are going to trade at what they used to trade. I don't think you should be trying to value them on a revenue multiple perspective. I think the only way to value a Salesforce, a ServiceNow, Adobe, a HubSpot is an earnings multiple. And when I look at ServiceNow, when I look at Adobe, when I look at Salesforce, they're trading at historical low earnings multiples, but also much lower than the average for the S&P 500. And I think there's a little bit of room for these stocks to come up. So if you want to trade, I think there are those stocks to look at. I think things like MongoDB are really interesting. Whereas if you're Monday.com, if you're Atlassian, I think these sort of like productivity softwares, I think are screwed. And I would not build a position in them. And so mine would be ServiceNow. I think ServiceNow has a lot of stickiness in the enterprise, a lot of stickiness.
The disclaimer that what's the disclaimer that goes?
That this is financial advice. Take it, go make some money, and send us a thank you.
Buy silver.
Everybody, thanks for listening to Topline. Welcome back, AJ. Give us 5 stars wherever you get your podcasts. Chime in the Slack channel. We've got a great community. Thanks to all of the people that have been contributing, especially Jackie and Mary for listening all the way to the end of last episode. And participate.
Their books are on their way. I got their address. Going to send their books.
Thanks, everybody. Talk to you soon. Bye.